Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Hello everyone, Chad Frantzen. Welcome to the Kingdom Finance Show. I'm so glad you're here. Hey, this has been a lot of fun recording these weekly shows, and if you're enjoying it, please leave us a review and subscribe, and we're really excited to connect with you. So on today's show, we're going to take a kind of a deep dive into what's going on in the economy here in the United States and how that's affecting our thoughts on investments. So I want to just provide clarity out of chaos and give some perspectives on the economy today. So let's dive right in for today's show. And if you want to learn more about what we do and how we can help you create Kingdom Impact investment strategies for your family, visit us online at wealthbuilders.net. And if you're new to us, we also have a free download we'd love to make available to you. You can go to wealthbuilders.net/invest, and we rotate some different resources through there. We have a Pro Values Index. We have a list of some banks that you want to avoid given what's going on with the banking crisis. So please connect with us. We'd love to hear from you and get your feedback on what you're doing. Again, the heart behind Wealth Builders Investments and the Kingdom Finance Show is really to empower people and come alongside individuals who really have a burning desire in their heart to use the resources God has given them, whether that is money or ideas or influence or businesses, and use that for the glory of God. So we call that kingdom investing or kingdom impact investing, but it really encompasses your entire walk, your entire life. Like there is no divide between the sacred and the secular. And I've written about this and talked about it in some other places, but we have got to, as leaders and disciples of Christ, we have to understand that all of life is worship, as A.W. Tozer said, and that there's no divide, whether I'm running a business or trying to be a good dad at home or a good neighbor or a good employee or entrepreneurs. Everything is an opportunity to worship and give glory to God. Amen. So we talk a lot about that. And so if you're listening to this, you hear that sound and you are our people. And so I want to thank you for just being obedient to God and the Holy Spirit nudging you to learn more about being a good steward and going beyond just getting out of debt and tithing, but actually the more that God calls us to. So, God's kingdom economy is not shakeable, as it says in Hebrews, and he's not nervous, as he says in Psalms 2. In fact, he laughs when he looks at the plans of man. And so that's part of what we can rest in this day and age is the ultimate perspective that God is on his throne. He's given us his Holy Spirit, and we know how this ends. And what happens between now and then is our opportunity to co-labor, to partner with the God of the universe in what we put our hands to. So let's dive in. I want to give you some economic perspective today on today's show. So I want to cover really 5 key economic points. So I'm going to go through each of these 5. And then I'll share some interesting statistics on what's happening in the economy with the Federal Reserve and interest rates, and then also with the job market and where we think, again, we're filming this in May of 2023, kind of what our investment committee, our firm believes is coming down the pipe for the summer and into the fall. So I'll give you that as we wrap up. So all right, well, let's dive in. So I'm going to cover 5 key economic points for what's going on in the U.S. today. And so let's start with point number 1. And point number 1 is that the United States GDP, which is the gross domestic product, it is how the economy is measured. It grew at an annual rate of 1.1% in the first quarter of 2023. And that was well below the consensus estimate of 1.9, almost 2%. And so what that tells us, so key economic point number one is that the economy, although it is above negative, it is above zero, it is growing at a much slower pace than what most of the experts are predicting and hoping for. So again, the concept there is that the economy is slowing down. Growing at an annual rate of 1.1% is not that amazing. That's not really lighting things on fire for it. Now, the academic definition of a recession is 2 consecutive quarters of negative growth for this number. So if we're keeping score at home, we're at 1.1% on an annual rate through the first quarter of 23. Now, let's be clear, the U.S. government does take a different approach to definitions, and so it's hard to say that the current administration would actually even agree that inflation is higher than what is realistic for the average consumer, or that a recession may actually be happening or about to happen. But nevertheless, the data does not lie to us. Now, if we look at corporations, public corporations that are reporting quarterly earnings and forecast, I've shared on some previous shows, but a lot of major companies, major banks, major tech companies, large cap names that are in the S&P 500, they've been laying off thousands, if not over 10,000 employees from their global workforce. And so they clearly see the writing on the wall. The economy is slowing down. They need to trim and kind of hunker down for a long winter, as it were, when it comes to meeting expectations of their shareholders. So again, the economy is growing at a much slower pace. And when you combine that with point number 2, which is stubborn high inflation, and the personal consumption expenditure, PCE, it's one of the factors for prices in the U.S. Now that's inflationary. Now they do exclude food and energy, which I've never understood why, because I fill up my truck once a week, and I think we all go out to eat and go to the grocery store. So that has an impact on small business owners and families. But inflation is trending down, but it is still very stubbornly high. And so, as I've shared in past broadcasts, when you look at high periods of inflation in the 1980s, post-World War II, high inflation tends to stick around for 2 to 3 years. And so we need to be prepared as consumers, as kingdom-minded investors, to not go along with what the media is saying of, oh, this is fine, and inflation is gone away, and the economy is just back up, roaring. I want to take more of a contrarian view. It's not a fearful view, but I do think inflation is going to stay strong. The Federal Reserve has said they want to get inflation down to 2.5%, and that's going to take time. So I don't expect interest rates to go down anytime soon. There's some debate, which we can get into, on if the Federal Reserve will pause or pivot, as the media says, its interest rate policies. So we'll see if that happens this summer or not. I think there's a good chance they will put that language out here in June or July that they're going to pause on interest rate increases, but they're certainly not going to lower them anytime soon. So point number 1, the economy is not growing as fast as many say. Point number 2, inflation is still your long-lost cousin who won't leave when he comes to visit you. That's going to stay stubbornly high for the foreseeable future. All right, let's jump in. I've got 3 more points I want to share here in the opening. Economic clarity as we're in the second quarter of 2023. The third one is, you may have seen this in the news, but OPEC announced that it was cutting its production of crude oil by some million barrels. And that, along with support from Saudi Arabia, leads many to believe that the price of oil which is currently in the low 70s, so around $70 to $72 a barrel, could easily ramp back up north of $90 a barrel, could even hit $100 a barrel, just in time for the summer travel season. Well, if that's not a tax on the American consumer and global travelers, I don't know what is. So that is economic point number 3, is that oil prices, because of these production cuts by OPEC, will likely lead to increased cost. Again, that affects the bottom line of consumers, you and I, and our budgets and what we're spending on. So that's an important development. So you want to keep an eye on that. Again, I think oil prices could easily go up 20% from here on that. Now, that's bad if you are like me and you have an F-150 pickup and you're filling it up. Now, as an investor, how I benefit from that is I position my investment portfolio to include companies, public or private, that benefit from rising oil prices. So if OPEC wants to play the cartel game, which they do, and they do a great job of that, then, I might have an electric Tesla or something. But I also would have investments in my portfolio that their whole business model benefits from higher oil and gas prices on that. So giving you a little bit of my playbook there. Again, we like the energy sector. I think that makes a lot of sense. Side note, the Oracle of Omaha himself publicly disclosed that 2 of his largest holdings in the company are Chevron Mobil and Occidental. So he's very bullish on the energy sector. He's also a big investor in Apple and some of the banks. But nonetheless, I think that's good for us to discern what other really successful investors like Warren Buffett are doing. So I like energy. I like energy here. I think it makes sense in a portfolio. All right. Economic point number 4 is the big tech mega cap, the Facebooks and Googles and Microsofts of the world. They have been reporting earnings here at the end of the first quarters in April and into May. And a lot of these big mega tech companies, which were down terribly in 2022. Their stock prices were down 30 to 40%, some even more. End of the year and first of 2023, the news headlines were these companies, Amazon and Microsoft and others, are slashing their global headcount as far as employees. And wouldn't you know it, they laid off thousands, if not over 10,000 people, and they were able to make their earnings for the first quarter. So due in part probably to cutting a lot of the overhead. But Wall Street loved it. So these big tech companies soared after reporting positive earnings, better than expected, partly due to just laying off a lot of people. And that has led to a lot of institutional investors just going right back in to taking big positions in these big tech company names. Now, our opinion on that is that's not a strategy we want to take right now. I think there's a lot of downside in the stock market right now. I think that's what we're learning with what the bond market's saying and other economic indicators, which I'm not going to get too deep into on today's shows. But I think the big large cap names and the tech names, I think certainly when the recession really hits, which I think we are on the precipice of it with the economy slowing growth, only at 1% per year, that the trend is not our friend in that regard. Short term, perhaps, but I think we get into the fall, and I think if you're day trading and getting in and out of companies, that's one thing. But if you're a long-term investor and you want to apply kingdom principles, you don't want to play that game. And either way, I'm not going to invest in those big tech company names because of their policies that are totally against my values on that. So All right, point number 5, economic update here to give us some clarity is the banking crisis continues to march on. There was another bank, First Republic, which became insolvent at the end of April. And lo and behold, to their rescue was none other than J.P. Morgan Chase, who came and took over the struggling bank, First Republic, before the beginning of May on that. So again, I personally believe the banking crisis is not over. So I want to encourage you, whether you are a small business owner, if you work for a large corporation, if you're a retiree, I want you to really evaluate what banks you're working with. First of all, a lot of the really large banks are very woke. They're very much pushing the liberal agenda, and J.P. Morgan obviously has connections to a lot of different things, such as sex trafficking and the like. And so even from that standpoint, from a value standpoint, I don't want to be banking with the big banks. So I think we all know who they are. So those are ones. My personal opinion, for what it's worth, is I would not be following that. I would be looking for local community banks, credit unions, preferably those that are value focused and not anti-Christian, to do my small banking with. Now, that being said, I think the crisis in banks is going to continue. I've covered this in another show, but just as a reminder, I think commercial real estate and commercial real estate mortgages that are on the books of a lot of these regional banks is the next shoe to fall. There's a lot of mortgage paper on commercial assets. Think office buildings. Think office buildings in large cities. And how are those doing in a post-COVID world? A lot of people are back in their big offices, but the big corporate office towers in a lot of these major markets, the top 20, 25 metropolitan markets, they have debt on them. They have mortgages through banks. A lot, and in fact, the majority of them are held through regional banks, and a lot of that paper, a lot of those loans are up for renewal in the next few years. So that is it's not going to end well. It's not going to end well for these banks. So I want to encourage you to be aware of that, and just don't assume that the worst is behind us on that front. Could that be a harbinger for a stock market decline of 20%? It could. I guess we have to see. It could also be a major geopolitical event that happens. God only knows with the leadership we have in the White House right now, and public policy and geopolitical things. All right, so those are your 5 key economic points. Again, we talked about number 1, the economy is slowing down. Number 2, inflation's not going anywhere. It's very stubborn. And what that leads to is what's called stagflation. So if you're an investor and you're trying to understand how do you create a wise plan for stewardship of your business, of your finances, your investments, you want to understand this concept of stagflation, which is that the economy is slowing down and inflation is elevated, right? So you have high inflation, even though it's come down some, but the economy, as measured by GDP, right, is slowing down, right? So that is the definition of stagflation at its most basic level. That becomes a very challenging environment for investors, for small business owners to navigate. So those are the first 2 points, economic points 3, 4, and 5. Just as a recap, we talked about OPEC and oil production. We think oil prices are headed higher just in time for the summer holiday season. There's ways to benefit from that. So you want to pivot or include energy investment strategies in your portfolio, in our opinion. We talked about the mega cap tech names. There's a rotation back into that. We are not participating in that. I think that it will be short-lived. And I think when we get into the fall and we see a formal recession really hit the stock market, these big names will go down much more than a dividend paying energy company or a dividend paying utility company. And then I also mentioned banks. The banking crisis is not over. I really want you to pay attention and be aware of the banks you're working with, both from a value standpoint and if they're expressly promoting the liberal agenda and anti-Christian, and then also just from a protection of your assets. If you have over $250,000 in a bank and it's registered in your name, any amount over $250,000 is not federally insured through the FDIC. Now, at our company, Wealth Builders Investments, we're an SEC registered investment advisor. You can work with other investment firms to help you get monies that are over $250,000 to get that properly diversified and insured across different types of banks and institutions, and in some cases, things like insured CDs. Again, I'm not giving you investment advice here, just sharing with you how that concept works. And that's a lot of what happened with these banks that have failed is they had a large percentage of deposits that were uninsured on that, which is exactly why the Fed, the U.S. Treasury, and J.P. Morgan and the like had to jump in on that. So we do have a list of the banks that have the most exposure to uninsured deposits. And so if you'd like to get a copy of that list, reach out to us through wealthbuilders.net. You can also get that at wealthbuilders.net/invest, and we'll send you the bank list. So again, this is all public information that of the top banks that have the most exposure to uninsured deposits, and there's some familiar names on there. So you couple that with commercial real estate, and we're going to see some more pain in the banking industry. All right. Well, I hope that was helpful. A couple other indicators, a lot of the economic indicators, which I cover in some other places, such as the Buffett indicator and the yield curve. A lot of these indicators continue to say, folks, that both in the stock market and in the bond market, that they're saying the same thing. The data says the stock market is still overvalued. The Buffett indicator, made famous by Berkshire Hathaway and Warren Buffett, it still says that the market is probably one standard deviation above overvalued. Now, that's just a technical term, but what it means is that the market really needs to see a retracement, a correction of 15, 20, 25% to get truly back to fair valued or attractively valued. Now, I talk about this elsewhere, but in the bond market, if any of you have gone to invest in a CD or buy bonds, if you self-manage your investments, the yield curve's inverted. And of the last 10 recessions, the yield curve has accurately predicted all 10 times a pending recession. And I don't think this time is going to be different, regardless of what the media says, regardless of what government officials say. So the last 10 recessions, going back to 1972 and the oil embargo, every time the bond, what's called yield spread, it inverted every time a recession occurred. And so the yield curve is inverted. And just to keep this more informational and not technical, what that means is that if you have money to invest and you want to buy a U.S. government bond, it means that you will earn a higher rate of interest if you invest in a 1-year U.S. government bond versus if you go invest in a 10-year U.S. government bond. Now, the laws of math and supply and demand would say that if you invest longer, you should earn a higher rate of return, right? So it should be that a 1-year bond would pay you 2%, let's say, and that a 10-year bond would pay you, let's say, 4%. But currently, it is the opposite. And so what that means, it's like a check engine light. I had to take a vehicle in for repair and you get one of those check engine lights, because they're all computerized now. And this is a major check engine light here that's saying, hey, the engine's running too hot. Okay, something is broken and it's going to need to be repaired. And that's exactly what this yield curve is telling us. The bond market is an excellent indicator, predictive indicator on the economy and on policy. It's not usually wrong. And this particular spread has accurately predicted all 10 of the last recessions. So I firmly believe we're going into a recession. The economy is only growing at 1%. Corporate earnings are negative for consecutive quarters for a lot of companies. And a lot of the companies are only making their earnings now because they've slashed headcount, right? So they're just making the numbers work. Not because they're selling more product, but because they're just trimming and laying off more people. So again, I want you to be aware of that as you're thinking about, hey, Chad, how do I become a kingdom-minded investor? We just have to understand the state of the economy, right? And so I want you to be prepared. I hope this has been helpful to give you some perspective on where we are here in the economy. Again, the indicators in stocks, the economic indicators, and the bond market are all pointing to the economy slowing down, potentially turning negative, inflation leveling out, coming down, but not going anywhere. We're nowhere near the 2% that the Fed wants us to be at. And this yield curve, it clearly says to me, when you're managing resources, which is what we do at our company, Wealth Builders Investments, you need to be very defensive, and you need to wait for opportunities, right? There will be opportunities for different asset classes, but you got to be patient, right? Whether you're buying real estate or investing in stocks or ETFs or even commodities, you really want to wait for your pitch, as they say in the baseball world. So, hey, I hope that's been helpful. Again, Kingdom Finance Show, we're really committed to educating and empowering you to make sense of the economy and make wise financial choices for your family, for your community, and also for the glory of God, so that we can make an impact, not only now, but for future generations. We'd love to hear from you, so please subscribe, give us a review on the show. And then if you want to learn more about the resources we have, again, we've got the Pro Values Index, we've got the bank list. Love to get that in your hands so you know what banks to avoid. Again, connect with us at wealthbuilders.net/invest, and we'll send you those free downloads, both the Pro Values Index, what companies to avoid, what companies to embrace, and then our bank list is just a list of banks that are most exposed with uninsured deposits. And so we think that's going to continue to be a storyline. We want you to be aware of that and taking action depending on what banks you're working with. So connect with us online, and we'll send you that free resource, wealthbuilders.net/invest. And this is Chad Frantzen. Thank you again for being here and listening. And we'll see you next time on the Kingdom Finance Show. Take care.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show.